So the first question, which I won't surprise you at all, that I wanted to ask you is if you could pick just like one main metric that you obsess over when it comes to SaaS companies, like when you see, someone's pitch deck and like the page you flipped it to see what is the thing that, like
Right.
what is the thing you're looking for to understand a business?
Yeah. So my background was venture and then lending. And when you think about lending, you really care about the stability of the revenue stream. So retention is always where we focused. Even literally 15 years ago, we were, sort of trying to figure out the best way to do retention. So net dollar retention tells you both the stability of the revenue stream, but also what we think of as sort of the capacity to grow. So
Mhm.
obviously, when that's over 100%, it shows you that, hey, this business is really set up to grow nicely because, all new bookings are additive. And if you struggle with the retention, it's a less stable business and it's harder to grow, right? Because you're having to sort of refill that bucket. So I know NRR slash NDR has become super popular lately, but it's kind of been the drum we've been banging on for a long time. And it has, and I've written a fair amount about this, it's a cumulative number. So over time, it has this amazing impact on your valuation because it builds your ARR, which is one of the components of valuation, and it also supports higher growth, which improves your multiple. So you get this amazing compounding effect when you have high net dollar retention. So that's my one.
A related question to high NDR. A lot of companies that we work with, they struggle with this idea of LTV when they have pretty high NDR, especially when like, let's say, you have a customer retention that's like pretty good, like, but not amazing, like 80% or something like that. Then you have NDR that's like 130%. LTV becomes a very hard thing or like a slippery concept. But what do you recommend people think about when they're in that type of situation?
You're right. It's hard. I think, in my opinion, sort of lifetime value is something you look at every once in a while. It's not a metric that you track necessarily or react to monthly. You got to make sure it's sufficient to support your spend or your investment in a customer. But as it approaches 100%, it becomes a really weird number. Right? It's like, oh, this, because if you have retention over 100%, your lifetime value is infinite and it just keeps growing. And that's not really helpful and not really true.
Yeah.
So it is interesting. We looked at lots of companies where there was this pretty big gap between, net dollar retention and maybe gross retention. One, I would look at it on a gross basis and just get sort of a decent baseline. And then you might segment that customer base, right? I have another company I'm working with that has hundreds of little customers that churn on a pretty regular basis. And then they have enterprises that grow like 300%. And like you can't, if you add those together, you get just a shit show. You can
It's
edit that
not one
out.
business.
Yeah, it's not one business, and it's not, and the median is not helpful at all. It doesn't tell you anything.
Not anything.
Right.
That's a good point. Also in the NDR front, you wrote up a really awesome piece on Snowflake and their metrics, and I would love if you could share a little bit more context around the stuff you
Sure.
observed digging into.
And just to be clear, I'm not in that piece, didn't slam Snowflake at all. Um, it's just they reported this really curious set of metrics.
Yeah.
They reported net dollar retention of like 170-ish percent, maybe 175, 172. But they forecasted growth in ARR at 65%. You're like, well, wait, NDR is supposed to be, hey, if I don't sell any new customers, this is not going to be my growth rate. And you're like, how can this be? And two things are going on. One is they do calculate NDR differently than anybody else on the planet. So, you sort through all their public disclosures. And a customer has to be a customer for more than a year to get included in the beginning in NDR, and then they need to be a customer another year before there's actually a calculable number. So it's looking 2 years in arrears. And that's pretty unusual. Most companies doing cohort static pool are looking a year in arrears. And there's a reason they did that, and which is the second point. And I think they were in good faith trying to solve for a problem, but it really creates this incredible lag in terms of your reporting. The other thing that's interesting about their business is even when they sell into the enterprise, they sell, what do they call it? Sort of starter kit, proof of concept things. So even if they're selling into Procter & Gamble, right, it's going to start small. And so they have this 1 year ramp or more than 1 year ramp in all of their businesses to just get them onboarded, right? And when you're looking at NDR, you're like, oh, ramp up phase versus static phase. It might be a 300%, 500% difference.
Yeah.
And that's what's driving their net dollar retention. And the weird thing about that is it's a function of new bookings, not a function of actual underlying, gross retention and cross sell and upsell. So they've got a different business. I don't fault them for the way they're trying to calculate NDR, because I think in a way they're trying to mitigate that because the customer had to have been around for a whole year. But they do need a different metric, and it surprised the street. I mean, their stock got hammered. They need hey, once a company reaches X, it's a sustained implemented customer, and then we'll do a bunch of metrics on that cohort. But when they're in the ramp up phase, that's a different group. So that's my recommendation to Snowflake, and they have not called and asked for it, shockingly.
It's interesting because I think it feels to me, I don't know if you agree with the summary, but it feels to me like the thing you're pointing out is that a cohort chart is a two-dimensional thing, and they're basically turning it into, like, you have to turn it into a zero-dimensional thing, like one number. And they're trying their best, but their cohort chart has these like differing sort of rates of NDR depending on the life cycle of the customer, and trying to summarize that in one number is just, I don't know, hard.
Yeah, and I think they needed to do a better job sort of signaling that, because they were just, they went public at 133 times ARR.
Right.
So we're kind of living on that incredible NDR number. And I don't think the analysts realized a lot of that was driven by these new customers ramping up, which is very different than your installed base growing at 70% every year, which is virtually impossible, in almost any business.
I have another sort of related question, which is, I don't know if you've ever looked at the Costco annual report.
Yeah.
They publish a cohort chart in there, like a full-on cohort chart, and you can see by store opening date what revenues look like on average. It's pretty cool. And so one thing I wanted to ask you was like, who else does this well? Like, who else like actually explains cohort behavior in like a setting like that?
Yeah, I don't know. Despite what I wrote about Snowflake, I don't really cover the public stocks that much, although I am writing one additional piece. So I have not dug into a lot of the
Yeah,
annual
just curious.
reports. Yeah, companies, I see them doing it around fundraisings. And the other thing I've seen, especially in the later stage fundraisings where there's more data to analyze, there's more dollars at risk, and the private equity firms are dipping down into, as you know, sort of doing Series B or whatever. They don't, a lot of them don't look at the company's metrics at all.
Yeah.
They're like, that's interesting. Give us MRR by customer by month. And we'll do our own analysis. And so this one company I was talking about that had these various different groups, they got the cohort analysis back from the VCs, and that shouldn't happen. You should be on top of that ahead of time.
Yeah.
And once you sort of, and cohort analysis can be super like, oh my God, that's so much data.
Yeah.
You know, you need to be proactive to put it in the best light that you can. And we ended up doing that, but it was sort of after the fact with a couple of the VCs.
Yeah. Um, are there things that you feel like are common sort of mistakes companies make before they go out for a fundraise? Like things that, you think people should have put together, but frequently don't?
Yeah. Um, I think that's one of them. And you can do, like we said, cohorts a variety of different ways by the month closed, by the kind of customer, by ACV. You can do stuff by product. I don't know that there's any one specific area. It tends to be there's CEOs who are very on top of their metrics, and then there's CEOs that I think feel like, my job is a level above that or something like that, or maybe they're just not interested or they're very much a product person or whatever. I will say, having funded 70 of these companies and talked to thousands, there is a correlation between the CEOs who know their business well and success.
Mm.
You do get nervous. Not that you can't be successful as a CEO without getting in the weeds, but there's a correlation for sure. And
Yeah.
you get a little nervous when the guy's like, I don't know what our MRR is. Like, what would you guess it might be? It's like, come on. Or retention, don't know the difference between gross and net, et cetera, calculating in a weird way. But to know one specific area, but there is a delta in terms of how much CEOs engage with it who are doing the fundraising. So if you're not a metrics person and you're going out to do fundraising, become a metrics person.
Yeah.
Like, you need to know the answers to that. That will give confidence to the investors for sure.
Yeah. Totally.
I'm
Um,
sure you know the metrics left, right, and upside down.
I'm definitely wired that way. But there's like other parts as a CEO where I'm less good. So it's,
Right.
there's ups and downs.
Sure.
Um, I think you've probably noticed and then done a lot of thinking around the fact that there's so much more usage-based pricing nowadays than there used to be just not very long ago. Um, I'd love for us to start with maybe just like how do you think about, or like how do you even define seat-based versus usage-based? And like what are the boundaries that you think about there, since it's almost like a continuum?
Yeah, I mean, usage based is what it sounds like, right? It's there's some metric, maybe several metrics that get combined, and then the customers build based on the amount they use. They could be billed in advance, they could be billed in arrears, it could be part of a larger contract. It could have tiers, where as long as you're inside the tier, it's the same thing. So there's lots of different varieties. Also, most usage-based pricing now, just over 50%, is now done in combination with some other form of pricing. So there might be a core level, just enterprise amount. There might be seat, based pricing, and then overages, or so you're getting a wide variety of different approaches, which makes sense if you're seat-based.
Yeah.
What we're seeing a lot of now is companies want to do more product-led growth. They want to get higher NDR. They're launching products that are usage-based in conjunction with sort of their maybe enterprise seat-based approach. Yeah, so it's crazy and growing so quickly, and there's even more companies looking at it, right, than have implemented it.
What are your what's your perspective on what kind of products and companies lend themselves to usage-based pricing?
Yeah, so I wrote a pretty lengthy article on this, and it was really just looking at the public companies that are leveraging usage-based pricing and grouping them. So not surprising, a ton of what we call lower in the stack companies do usage-based pricing. So I wouldn't say low value added companies, but they're just lower in the stack. It's Snowflake, right? It's some utility computing. AWS isn't a SaaS company, but they do a tremendous job with usage-based pricing. And those are relatively high cost of goods sold businesses. And literally, that's why they adopted usage-based pricing. And the guy at Snowflake said, well, we had to because we had these direct costs on the other side. It wasn't like this brilliant strategy to drive NDR, but it's working. And it is a good alignment then, right? The other really interesting group is like the other end of the stack, right? So you've got lower in the stack, and then you've got any SaaS applications that touch revenue. There's an aggregation of usage-based pricing there. So it's e-commerce companies, it's payment companies, and they do have some direct costs, but I think the bigger driver there is it aligns so well with value, right? Like, oh, my e-commerce store sold X. I'm happy to pay a percentage of that, because I won't be paying more for my store unless it's generating more.
Yeah.
So if you're a company and you can find a metric that aligns itself to revenue, I think that's a fantastic place to try to start with some usage-based pricing. So we're seeing marketing companies do that. HubSpot's a great example because HubSpot uses seat-based pricing for Salesforce management, right? Because your value is being delivered to a person, a salesperson, right? On the marketing side, they don't. They base it on contacts, and contacts are a proxy for, well, your marketing universe is bigger, so hopefully you're generating more revenue. So they use different metrics based on sort of where the value was created. And there's still a lot of companies that will and should continue to do seat-based pricing.
Yeah.
Like a learning company, right? You're training people. The person is the person who's a human being has benefited. It should be on the seat basis, right? And then there was one other group was other high cost of goods sold companies. Falling into this would be any companies that have a communications feature, Twilio or others who have, direct sort of, I had to send an email, even email companies, there's some direct costs there. And then AI companies, because they're using a tremendous amount of compute, right, will have also gone to usage-based pricing because they have a decent cost. The other thing, which isn't really a type of company, but something to think about, if you're serving a customer base target that isn't high growth on its own, if you pick a metric that that's relatively stable inside that business, you will get no advantage from usage-based pricing. So think of like appointment setting in doctors' offices. They're only going to set so many appointments.
So true.
Right. So like you can go to usage-based pricing and then it'll just be static and it'll be like, where's my NDR and all the other things that are supposed to happen. So you need to look for metrics that have sort of asymmetrical growth capabilities. Or if you're greenfield, you can, target high growth industries where at least those metrics will likely grow at the same pace the company grows.
When you're a SaaS business selling to non-high growth businesses like doctors' offices or like, other similar businesses that, aren't intended to be growing super fast, how do you think about NDR? Is that just not a metric you focus on?
Well, you would get there a different way. And I've got another piece coming out, which is called How Do Sales-Led Companies Leverage PLG Tactics? And so one of them is simply disaggregating your product into more easily consumable modules. So one company we're working with, they literally did an analysis to find out. Now it was human capital management, and they already had a fair number of different modules, but they did an analysis to figure out, okay, what's my best CAC, easiest to sell product?
Mm-hmm.
And they put all their energy behind that product
Mm-hmm.
in a very intentional land and expand sort of strategy. And then, they would go back and sell, 3, 4, 5 different modules to that customer over time. But they didn't ask for a big check up front.
Yeah.
When the knowledge between the two organizations is at its lowest,
Yeah.
right? They're like, oh, let's just get started with this. And so if you're selling into a doctor's office, in theory, you would really want to think about your product strategy and drive NDR more through cross-sell and upsell than relying on usage-based pricing. And you might have a product that has some usage-based pricing, but not necessarily.
This is maybe getting way too in the weeds, but one of the things that I feel gets like a little bit harder in the sort of heavy cross-sell businesses is, how do you think about your overall sort of CAC? And do you allocate sort of the additional cross-selling all to COGS? Do you allocate it to sales? Do you allocate it to, I don't know, something else? Do you have thoughts?
Not really. I mean, it's a company by company thing. I've definitely seen companies say, okay, our new logo CAC is this.
Yeah.
Our expansion CAC is this.
Yeah.
It seems a reasonable way to
Yeah.
try to do it. But CAC is full of, lots of nuances anyway, allocations and something.
I think we hit on this question from two different angles, but I think it's still worth sort of putting them together, which is when you have usage-based pricing, how do you think about net revenue retention? We talked about Snowflake a bit, but still worth, I think, exploring that a bit deeper. Would love to hear. And you have a really good piece about this.
So I would just say, yeah, a couple of things. One is, if you can do it, right? If your product is set up to benefit from usage-based pricing, and you can pull it off, it's amazing, right? It's literally frictionless growth from quarter to quarter from your installed base, with none of the cost associated with that cross-selling efforts that we just talked about. Cross-selling is still selling, and it still takes a lot of energy and effort. And usage-based pricing, while there may be some people in there to encourage more usage, et cetera, it's still a much more efficient way to do it. So I think as usage-based pricing relates to net dollar retention, it's the best way to drive net dollar retention. And there's evidence that the market will give you a premium for that. What we haven't seen, and my friend David Spitz, who was an analyst at Pacific Crest and KeyBank, not an analyst, sorry, a banker. He's like, what about when usage goes down, right? Like, we've been in this economy that's generally been up and to the right. Like, isn't there a flip side? And so won't the other shoe fall? And I would say this, for most of the companies I've talked to that are utilizing usage-based pricing, they do have some things in the contract that make it look more like a ratchet as opposed to a yo-yo, right? So floors get established. And if you can, I guess, get away with it, right? It's a great way to do it. So I don't think if you saw a slowdown in the economy or usage go down for any particular reason, you would see the exact same percentage decrease in revenue from these businesses, because they do have sort of some contractual layers built in.
Great point. In your ideal world, what's something you wish people could go a level deeper on when it comes to metrics? Like, I don't know, maybe being able to separate them out by product line, or going deeper on some portion of cohorts, or anything like that. Is there a thing that you were like, I wish people could go farther?
Yes, and you just mentioned them both.
Okay.
So product's really interesting, and not many people are doing it. And I think there's two things on product. One is if you're pursuing a product-led growth strategy that has multiple products in it, you definitely need to sort of do some analysis there. And you have to have the GL set up in the right way and tagged properly. And there's some real data that analysis that goes with all of this, which on the usage-based pricing front is super painful, by the way.
Yeah.
So
Totally.
research shows the number one reason why people don't do usage-based pricing is they can't find the right metric.
Right.
But once they find the right metrics, the second thing is they don't have the systems to do it. So there's some new companies out there that are helping sort of solve for that. And you might be one of them, but these are more like in the weeds data folks. I got off track. What was the question?
It was around like what?
Oh, product. Yeah. So product. So you have to tag it right.
Yeah.
But then, retention by product, right? CAC by product, which is the one company leverage very useful. Like, why are we spending all of our sales resources against all these products when this one is so easily and readily adopted? So let's go do that. And then ultimately, I think when you get to some level of scale, you should be looking at profitability by product. And that's relatively hard to do because it's hard to disaggregate the cloud data bill, or just the cloud bill. The AWS bill is like this big monolithic thing that comes in. But again, some products helping with that. But that's important, especially when you get to usage-based pricing, et cetera. I wouldn't do it early on, like, a smaller company. They're like, okay, well, our gross margin is this.
Yeah.
So our product's gross margin is that, right? But if you have a number of products having product profitability at scale, if you can tweak a point or two out of gross margin, that's a pretty big deal.
Yeah.
And then customer level profitability, right? Some people are like just banging your servers all day long and you're not getting rewarded for that. And so in theory, you could be upside down on some of these customers. But again, at scale, I would think no company below 5 million should be sort of messing around with this kind of analysis because any customer is good.
Yeah.
Revenue is good.
Yeah.
Sort of you're optimizing for margin sort of later.
Yeah.
And then I would say cohort for sure. We've talked about this, but just MRR by customer cohort, as to when they were signed is just this amazing thing.
Yeah.
And don't even try to my big thing lately is don't try to pretty up the data. Evidently our brains are wired where we can assimilate lots of different data points. So just seeing it, you can see some helpful, useful trends are the newer cohorts doing better? Are they bigger?
Yeah.
Are they maintaining their revenue longer? I think just looking at the raw data can be super helpful sometimes.
I couldn't agree with all of that more. Very cool. Is there a metric or set of metrics that you feel are regularly miscalculated?
I'm so frustrated that retention, Snowflake just chose to do it a different way. Come on.
Very hard to do apples to apples.
So, so I'll say two things. One, and I've written a whole thing on this too, is doing cohort retention metrics versus the formula approach, which is beginning MRR, churn over beginning MRR. And that can, as you know, if you have churn that is not associated with the customers who are in beginning MRR, you can get some absolutely wrong numbers. Right. So there's some real drawbacks to using the formula approach. I also see people measuring too short of time frame and extrapolating that and just creating really noisy metrics. So retention is 90%. Oh no, wait, it's 75. Oh no, wait, it's 95. Month to month to month, it really shouldn't be bouncing around that much. And when you take short periods and you annualize them, you get to that. And then my final thing that drives me nuts is when they're annualizing numbers. If they're annualizing a quarterly number, they multiply it by 4. If they're annualizing a monthly number, they multiply it by 12. that's not the way you do it. You take it to the exponent. So you take it to the 4th or the 12th. So I had people like, oh my God, churn times 12, like we'll be completely out of customers in 12 months. I'm like, well, no, it doesn't work that way because you have churn off a lower base. So anyway, just that tiny little nuance of when annualizing,
Yeah.
use the exponent, not just the simple multiplier. So
Yeah.
geeky guys like us,
Yeah.
get excited about
Oh, my thing is like when you annualize numbers, but you're a seasonal business. So the thing doesn't like make any sense whatsoever some months or any month. Like some months it's like ridiculously low.
Well, you were in the education business, right? So they're highly seasonal. Those companies drove me
Uh-huh.
nuts. Where you get aside a little bit, but when you do rev rec in those businesses, you get the perfectly smooth MRR line, which is great, which everybody loves about SaaS. But underneath is this, huge swing in bookings and billings and cash and
Right.
like you're just living for the another day. But you look at the P&L, it's like, oh, perfectly smooth, everything's going on.
Yeah.
So seasonality can be challenging in a SaaS business from the metrics and or cash flow perspective.
You know, you'll probably relate to this, but venture debt is really nice for education businesses because it can help with that like super low point in cash. But the business is so stable and the counterparty is like very good credit risk wise. So it like ends up being actually a really good sort of
Yeah.
business to do debt against.
Well, I think you just need to plan for it, right, and recognize it, and then it's like no big deal. But yeah, seasonal working capital lines, which banks have been doing forever.
Yeah.
That's a great use of debt, right?
Yeah.
It's like just a low point. I'm going to get paid back.
Yeah.
Yeah.
Um, those are the main questions I had for you. I'm wondering, is there anything that you wish I had asked or anything that I should have covered that I didn't?
I don't think so. I think we went pretty deep on everything. I will say, and we did not talk about this earlier. I'm working on, and Ray Reich is the guy who's really spearheading this, a group that's putting together, it's called the SaaS Metrics Standardization
Oh,
Board or Standards Board. I forget the name of it. But anyway, a bunch of people are going to try to get together and say, hey, here's how to calculate NDR.
yeah,
And we want to vet it with a bunch of people or whatever, but
yeah,
this is the standard. If you do something different than the standard, obviously that's completely up to you. But here's how we're seeing it done in most businesses. Here's the pros and cons of this approach. And we're going to do it across maybe 10 or 15 different SaaS metrics. Because still, as you know, we're getting this high degree of variability in the way people are measuring things. So a long time in coming, but start to look for some things from the SaaS Metrics Standards Board, I think is the name of it.
very cool. Much needed.
So a little yeah, I think so. And we're not going to try to get everybody to agree, but it's like, okay, here's how most people are doing it. Here's the right way to do this calculation, and go from there.
Yeah, so you can get some apples to apples stuff going. Um,
Yeah, exactly.
very cool. Thank you again for taking the time. This was so great.
Yeah, no, this has been really fun. Just geeking out on
Yeah.
metrics.
Well,
Nobody else wants to go that deep on NDR. So
I think folks will find it really helpful because I think a lot of the devil is in the details, and so you end up having to like go super deep before someone who's a practitioner can actually start applying it to their world. So
I think that's true.
I'm glad we did. I hope you enjoyed today's episode. Before you go, let me give you a super quick overview of what Subscript is because chances are we can help you. I started Subscript because in my last business, I had this problem. We had this giant Google spreadsheet, and that's where we kept track of everything about our business. And if you're anything like me, you're a data-driven leader who really cares to understand numbers in order to make sure that you're making the right decisions. But when you're looking at a giant spreadsheet with lots of just tabs on tabs on tabs and lots of people with access, you're probably not looking at the right thing because you can never be confident that someone didn't mess something up or that someone didn't fat finger a number or that you considered all the corner cases that you actually needed to consider. So that's what Subscript does. We help you understand your subscription business at a much deeper level than you ever thought possible. If you'd be interested in giving it a try, come check us out at subscript.com.